Part 2, Launch and Growth. Chapter 5, Startup Finance, From Bootstrapping to Investment, Fundamentals of Financial Planning for a Startup. Imagine you're embarking on a long road trip. You know your destination exactly, but without understanding how much gas you have, how much you spend per mile, when you'll need to refuel, and how much money you have for it, your trip will quickly turn into a nightmare with an empty tank. Financial planning is your onboard system and navigator. Revenue and expense. Forecasting, looking into the future. You can't predict the future 100%, but you can forecast it. This isn't fortune-telling, it's an informed estimation based on data. Revenue and expense forecasting is creating a detailed picture of how much money your startup can earn and how much it might spend over a specific period, usually 3 to 5 years into the future. Why is this important? Planning allows you to understand how much money you'll need and when for launch and growth. Decision-making helps decide whether to hire a new employee, launch a new marketing campaign, or develop a new feature. Attracting investment. Investors want to see that you have a clear plan for how you will make money and when you will become profitable. This is a key part of your pitch deck. Managing expectations. For yourself and your team, it's a benchmark. How to approach it? Revenue forecasting. Where does the money come from? Start with your revenue streams from the business model canvas. These are product sales, subscriptions, commissions, etc. Number of customers. How many customers can you realistically acquire? Use data from your market research, your SOM, and MVP results. Be as realistic as possible. Don't base your forecast on if everyone buys. Start small and show gradual but accelerating growth. Average revenue per user, ARPU. How much on average does each customer bring you? If you have a subscription model, this is the monthly or annual cost. Seasonality. Is there seasonality in your business? For example, ice cream sales grow in summer while ski equipment sales fall. Account for this. Pricing strategy. How will your price affect the number of customers? Will you offer discounts at the start? Example. If you're launching a subscription-based SaaS service, your first-year revenue might be calculated as number of customers acquired per month, average monthly payment, customer retention rate. Forecast how these metrics will change month by month. Expense forecasting. Fixed costs. These are what you pay regardless of sales volume. Office rent, salaries of key employees, insurance, licenses for basic software. Forecast these consistently. Variable costs. These expenses grow with your business. For example, cloud service fees, AWS/Google Cloud, will increase with more users. Marketing and advertising expenses will directly depend on how many new customers you want to acquire. The cost of producing each additional product. One-time expenses, costs for initial MVP development, equipment purchase, business registration. Marketing costs. How much does it cost to acquire one customer? CAC, customer acquisition cost. This is a critically important metric. Budget for the channels you identified in the marketing chapter. Salaries. This is usually the largest expense. Consider not only net salary but also taxes. Important tip. Don't hesitate to start with simple spreadsheets, Excel, Google Sheets. Create separate tabs for revenues and expenses, then consolidate them into one to see the overall picture. Be optimistic but realistic in your forecasts. Always create 3 scenarios: optimistic, realistic, and pessimistic. Investors often ask about the pessimistic scenario. They want to know that you've considered the worst case. Break-even point. When do you start earning, not spending? The break-even point is that magic moment when your total revenue equals your total expenses. Simply put, it's when you start operating at zero, no longer losing money and not yet making profit. With each subsequent sale after reaching this point, you begin to generate net profit. Why is this important? Viability. It shows that your business model can be profitable. Goal setting. It's an important milestone you're striving for. Resource planning. Helps you understand how much time or how many sales you'll need to become self-sustaining, and accordingly, how much money you need for the transition period. Break-even point in units of product equals total fixed costs divided by price per unit minus variable costs per unit. For example, if you have monthly fixed costs of $10,000, your product sells for $50, and your variable costs per product are $20, e.g. manufacturing, shipping, commissions, then your break-even point would be 10,000 divided by 50 minus 20 equals 10,000 divided by 30 equals 333.33. You need to sell approximately 334 products per month to break even. Important, this formula is simplified. In real life, it's more complex, as there are many different products, changing prices, etc. But the principle remains the same. You must cover all your fixed and variable costs. Practical advice. Visualize this on a graph. Draw a line for fixed costs, a line for variable costs, and a revenue line. Their intersection point is your break-even point. This provides a very clear visual representation. Cash flow management, the breadth of your business. If forecasting revenues and expenses is the plan, then cash flow management is the daily control of how money moves in your business. This is not about profit. You can be profitable on paper but have no cash to pay bills. Cash flow is the difference between money coming into your business, inflows, and money going out, outflows, over a specific period. Positive cash flow. More money coming in than going out. This is good. Negative cash flow. More money going out than coming in. This is normal for startups in the early stages. You're investing in growth. But you need to clearly understand how much loss you can afford. Why is this important? Survival. If you run out of money, you're bankrupt, even if you have future orders or large paper profits. Liquidity. You should always have enough cash to pay current obligations, salaries, rent, bills. Growth. Positive cash flow allows you to reinvest in development. How to manage cash flow? Forecast money movement. Create monthly or even weekly cash flow forecasts. When do you expect to receive money from customers? When do you need to pay suppliers, employees? Manage accounts receivable and payable. Accounts receivable, money owed to you by customers. Try to shorten payment terms. The sooner you get paid, the better. Accounts payable, money you owe to others. Try to defer payments without breaking agreements. Create a safety net. Always have a cash reserve for unforeseen expenses or payment delays. Monitor expenses. Strictly control your spending, especially in the early stages. Use software. QuickBooks, Xero, or FreshBooks will help you track all income and expenses, generate reports, and control cash flow. Example. You closed a large contract for $100,000. Excellent. But if the client pays in 90 days and you need to pay employee salaries in 15 days, you'll have a cash crunch, even though you're very profitable on paper. That's why cash flow management is crucial in business, especially in a startup. Tax aspects for startups. The laws of a big market. Taxes are an inevitable part of doing business, and you cannot ignore them. Tax aspects for startups in the USA are a very complex and constantly changing area that requires attention and, most often, professional help. I cannot provide specific legal or tax advice, as rates and laws are constantly changing, and much depends on your specific state, business type, and structure. Always consult with a qualified accountant, CPA, certified public accountant, and a lawyer specializing in startups. Don't skimp on this. Mistakes can be very costly. Nevertheless, here are the main points you need to know. Federal taxes. Income tax. All companies in the U.S. pay federal income tax. The rate and method of payment depend on your company's legal structure, LLC, CC Corp, SC Corp. We'll discuss these in Chapter 9. Payroll taxes. If you have employees as an employer, you are required to withhold and pay various taxes from their wages, e.g. Medicare, Social Security. This can be a significant expense. Self-employment tax. If you operate as a sole proprietor or an LLC owner, you will pay self-employment taxes, which cover Medicare and Social Security contributions. State and local taxes. In addition to federal taxes, each state has its own tax rules. This can include state income tax, sales tax, property tax, licensing fees, etc. Sales tax. If you sell goods or certain types of services, you will likely need to collect sales tax and remit it to the appropriate state. The rules for collecting this tax are very complex and depend on where your buyer is located. Franchise tax. Some states levy a tax on companies for the privilege of doing business in that state, regardless of their profit. Important aspects. EIN, Employer Identification Number. This is like your tax ID for the business. You will get it from the IRS, Internal Revenue Service, after registering your company. Quarterly tax payments. If your business is showing a profit, you will likely be required to make estimated tax payments each quarter, rather than once a year. Tax deductions and credits. There are many opportunities to reduce the tax burden for startups, including deductions for business expenses, research and development, R&D tax credits, and others. A good CPA will help you find them. Practical advice. Start early. Don't wait until the last minute to deal with taxes. The sooner you engage an accountant, the less headache you'll have in the future. Separate personal and business finances. Open a separate bank account for the business. This will not only simplify accounting, but also protect you legally if you've chosen an LLC or CC Corp structure. Record keeping. Accurately keep track of all income and expenses. Keep all receipts and invoices. This will simplify tax filing and help in case of an audit. Learn the basics. You don't need to be an expert, but a basic understanding of the tax system will help you ask the right questions to your accountant and make informed decisions.